Are you a home seller? Well, then prepare for a tough year ahead. According to a real estate group's prediction, property sales could see a significant decline in 2023 as more and more consumers are put off by rising mortgage rates and unaffordable housing prices. It's estimated that only 4.53 million homes will be sold in 2023, which would be a 14.1% drop from the previous year and the lowest number of real estate transactions since 2012, when the US was still recovering from the housing market crash and the Great Recession. Stay tuned to learn which cities are expected to be hit the hardest by the 2023 real estate crash. Before we get into it, please destroy the like button and crash on the subscribe button like it's one of the cities which will be hit the hardest to never miss any of our valuable content on proactive investing. Thank you. Now let's get on to the video. Real estate sales experienced a major boom as a result of the pandemic, which was fueled by work-from-home requests from numerous employers and historically low mortgage rates. Home prices have increased by about 40% since the beginning of 2020, and mortgage rates have more than quadrupled since the year's beginning, a double whammy that has pushed many potential buyers out of the market. Next year, sellers might bear the brunt of that effect. In 2023, high housing costs and mortgage rates will restrict the pool of qualified home purchasers. Housing prices would decline by 10% between June 2022 and June 2024, according to Morgan Stanley. In contrast, the US home market witnesses price rises by 45% between December 2019 and June 2022. Some places have already experienced a major decline in prices. Cities like San Francisco, Seattle, and San Diego are at the top of the list. These figures may appear concerning at first glance, but it's crucial to consider the big picture. First of all, a crash is not necessarily indicated by this degree of market cooling. The typical expectation is for prices to drop by at least 20% during a housing market meltdown. Unless we see a severe recession with significant unemployment rates, this is not even close to what experts are now projecting. It probably won't be as severe even then as it was in 2008. The United States has a housing crisis that has existed before the pandemic, which serves as the background for this discussion. Up for Growth and Freddie Mac specialists determined that America needs 3.8 million additional homes to address this issue as recently as 2021. The number may be closer to 7 million if you ask the National Association of Realtors. However, the new building is fading. Between October 2021 and October 2022, the number of housing starts was down by 8.8% and the number of requests for building permits was down by 10.1%. This implies that there is probably a flaw to any decline in property values during the coming year. Due to high prices, fewer individuals are able to purchase goods, but the limited quantity will probably prevent the supply from significantly surpassing demand. A quarter of renters currently pay their current landlord more than 50% of their income. Therefore, the outcome of this equation isn't pretty for them. It's possible that home prices won't drop to a level where these people can afford to purchase. For homeowners, though, it can offer a tiny bit of comfort that their danger of losing their property is lower. Foreclosure rates haven't yet approached pre-pandemic levels, even over the past few months, as housing values have started to cool in most regions. Furthermore, the market conditions that led so many people in 2008 to default on their mortgages no longer exist. The market that has experienced the biggest price drops would make for an ideal case study: San Francisco. The same issues that affect the national economy also affect the San Francisco market: unaffordable housing costs and high interest rates, albeit they were marginally lower in November. The main distinction is the greater elevation required for San Francisco. One of the most expensive property markets in the nation has long existed in San Francisco. The nation's highest cost still has ways to go. Since the epidemic started, there has been significant migration from San Francisco, with the county losing 6.7% of its population between July 2020 and July 2021 alone. One explanation for this is that computer employees, who are largely concentrated in this area, have benefited from some of the best chances to work from home as more roles began to become more remote starting in March of 2020. If you're still watching thus far, I know you're interested in a lot of other videos from our channel too. Don't miss out on any more valuable videos. Hit that subscribe button and join us here at Proactive Investing. You'll receive weekly updates on all things investing and economics. Don't wait, join Proactive Investing now. The next city is Seattle. According to economists, house prices are anticipated to decline or level out both locally and nationally. Home purchases will decline. Due to people staying put, rents may also rise more gradually than they have in recent years. Rents and property prices, however, will continue to be out of many people's price range, which is what defines inequality in Seattle. These are predictions made by real estate experts for 2023. The pandemic panic has subsided. After 2 years in which property prices, particularly in suburban areas like the East Side, shot up by double-digit percentages, prices are yet again falling. In a more existential manner, according to one report written by investment research firm Morningstar, waning affordability and consumer confidence have badly influenced the mindset among prospective purchasers. Given the prospect of a recession and the continued high interest rates, economists anticipate that this will continue in 2023. According to predictions from Moody's, Redfin, and Wells Fargo, national home values may drop by 4% to 5.5%. Zillow predicts that home values will remain stable across the country, which is a little more cautious than Seattle-based listing services. Seattle's fall will probably be more severe. The property market in the area is already one of the fastest cooling in the nation. San Diego. The increase in San Diego's house sales volume was not anticipated to last until 2022. Buyers are leaving the market quickly as a result of rising interest rates. In addition, the recession and pandemic-related job losses have driven away many prospective buyers and sellers from the housing market. Although they have so far been able to stay in their houses because of first the now expired foreclosure moratorium and then forbearance arrangements, those jobless homeowners with mortgages have discovered themselves to be late. However, as this forbearance plan lapses over time, many homeowners will find themselves in the midst of a forced sale after avoiding foreclosure in 2021 thanks to significant amounts of home equity. After the next downturn, which is predicted to hit in the second half of 2023, sales volume and prices should peak. Then, as more people start looking to buy homes again, the housing market will have its next sustained recovery, which is predicted to start around 2025. Los Angeles is next up on our list. The Los Angeles real estate market is gradually cooling down after a 2-year housing boom that was largely fueled by historically low borrowing costs. The number of houses for sale has increased while the number of buyers has decreased. Fewer buyers and greater inventory have reduced the likelihood of bidding wars, so buyers may find it simpler to offer less than the asking price. After reaching its peak in September of 2021, the median price in Los Angeles County has been fluctuating ever since. It generally rises from June to July. Thus, the fact that it dropped in July of 2022 was disheartening. However, in 2009, when all hell had broken loose, it even rose from June to July, giving this decline a unique perspective. The median home price fell 2.1% from the prior month and 1.3% from the prior year in November of 2022. Will buyers have more power in the Denver housing market in 2023? The Denver housing market is no longer in flux, according to market statistics from November. According to the DMAR, the housing market has grown more balanced. Home values are up by about 5% from last year, and homes are remaining on the market for longer. Despite the rising inventory, sellers are customarily delaying listing their home until next year. At the end of November, active detached listings were down to 4,572, a 16% decrease from the previous month, while attached listings were down to 1,681, an 8.9% decrease. Through 2024, the housing market is probably going to decline. Don't panic though, this is more of a market correction than a full-blown disaster. Demand will probably prevent home prices from plummeting into oblivion because there is a shortage of homes in America. In the long run, this could even be good for inflation. However, it's still possible that it could use some discomfort in the meantime. And that is all for today. Do you have any cities in mind which are likely to be hit the hardest? If you do, share your thoughts down in the comments below. If you found this video educational, don't forget to give us a big thumbs up and subscribe to Proactive Investing. Don't forget to watch the recommended video on why the housing market hasn't crashed yet. We'll see you there.